Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah. You're watching Indian Open. Let's go straight to the headlines at this hour. US and China talks ground to a halt after the Trump administration proposes to impose tariffs on goods worth an additional $200 billion. Trade tensions and Libya port reopening sends crude prices sharply lower. India is now the world's sixth largest economy, according to the World Bank, eclipsing France. And Croatia will play its first ever FIFA World Cup final on Sunday after beating England in the semi-finals. Well, let's take a look at the trade setup for the day. It promises to be a decent start in Asia, but yesterday's texture was more of losses that happened in the broader markets as opposed to the propping up of the index that happened, to be honest. There were a few names that are holding up the index, but the texture was more of losses for sure. Though the FI positioning on the index futures didn't change too dramatically. Not that it was expected, it was a very flat day on the benchmarks and therefore that wouldn't have really changed too much. But that's remained static. But it was essentially select buying in stocks like TCS and Reliance Industries which kept the index propped up. Now, we're talking about TCS all the day through yesterday. I just thought of taking a look at the kind of trades that happened in the big boy in the session yesterday. Ended up about 5%, 5.5% higher, 23 million shares traded. The delivery percentages on the NSE alone were to the tune of 40%. Just a rough math out here suggests that there was delivery-based buying in TCS of about 1,700 crores. Now, we saw a significant portion of some uptick coming into TCS post 12 o'clock as well, suggesting that maybe, just maybe, it was some bit of FI positioning that happened on TCS, and therefore the fund flows look very interesting, but these might just be for a day because FIs have put in about 636 crores to work yesterday. Provisional numbers, but nevertheless there is some bit of buying that's happened in the cash market yesterday from the FIs. It might be too premature to believe that it was largely on account of TCS, but what can safely say, looking at the delivery percentages and the nature of the trade that happened on TCS individually yesterday. Broader markets were a bit off. I think the mid caps and the small caps, despite the fact that the large caps did reasonably well, mid caps and small caps did come off in the session yesterday to the tune of about 0.5% apiece. So the market breadth was slightly wobbly in the session. What to watch in the session today? Well, crude, I think that remains the big draw in today morning's session. Maybe that is one reason why the Asian markets too are doing reasonably okay for themselves. Libya has resolved the major disruption that they had. Saudis have raised the output. Trade tensions anyways led to some bit of a pullback in early trade in the US markets yesterday as well. So crude is down. There could be some specific reactions for stocks, but typically crude falling dramatically does augur well for Indian markets well at large. So do watch out for crude and the impact thereof that we see. In today's session, couple of important events. The CPI and the IIP data will come out a bit later on today, so that is something you should watch out for. As also, the announcement for the HCL Tech buyback could come about. Now, we don't know whether it will come during market hours or post-market hours. My guess would be it will come out safely post-market hours, but that should keep HCL Tech as a stock in focus as well. Had one good day, then a one flat day. Again, yesterday's session, about 1.5%. Let's wait and watch what happens in the session today to HCL Tech. However, that may not necessarily be the stock to watch at 9 a.m. What are the stocks that you should monitor at 9 a.m. today? I think everything related to oil. OMCs would be the natural, obvious suspects. The crude downfall could result in a meaty bounce back. Remember the last couple of days, at least 2 out of the 3 days, OMCs have been beaten down quite significantly. Yesterday, they were amongst the top losers in early trade. Maybe we could see a bit of a bounce back in OMCs. And then watch out for the others. I mean, ONGC, GAIL, etc. All of them could have that sentimental and the resultant impact of the crude price fall. It's a sharp one, and which is why we're highlighting so much about crude right now early on in the show. That aside, a couple of other names, Century Enca, there was some stake sale by the promoter entities, so that is something that you should be watching out for as well. The promoter group sold about 1.8% stake on July 9th, so that is interesting. And there is a lot of bark before the bite, or a lot of rumor before the actual event happens on Fortis, but Economic Times is again reporting today that we could see some announcements to the tune of IHH getting Fortis at about 180 or thereabouts is something I believe they've reported. Let's wait and watch if that indeed turns out to be true or no. So 2 or 3 names that we should watch out for in trade. However, what's lined up on First Word today? Remember, it's a collection of the top editorial stories that we believe we should bring to you first up on the show. We speak to Shri Parvai Karasu of FGE to get her take on crude prices that fell to a 2-year low overnight as trade tensions rise and Libya reopens its crude port. It can only be good news for the paint sector that's been rallying for the past few days. Yash Upadhyay tell us how and why. Darshan and Johnson to tell us about what's working for Tata Elxsi. Remember, 4% up yesterday, clocking in new highs for itself. And last but not the least, Nikki Johnson to talk about what's hurting road developers in the country. It's not too often that we see in the last 12 months that road developers are getting hurt, so it'll be an important piece to monitor as well. However, the big news for the day is oil. It steadied after its biggest plunge in over 2 years. Resumption of Libya's eastern oil exports, higher output from Saudi Arabia, and trade tensions all weighed in on crude prices. Are crude prices finally easing off? I think that's the biggest question. Let's ask Shri Parvai Karasu of FGE. She joins us on the phone line from Singapore to talk about that. Good having you. Thank you so much for taking the time out and speaking to us at Bloomberg Quint. You know, a lot of technical experts who I read about on the international website seem to suggest that we've broken some key trend lines, and the lack of support suggests that there could be some downsides. Now, that's one thing. The key factor is, do fundamentals now support some more downside to crude, or is this just a flash in the pan?
I mean, we think, this is really a knee-jerk a response from lots of announcements. We know, Libya announced that they are bringing back the exports. And we also heard from Canada that Crude outage will be restored. The second half of July, there will be a partial return of about 150 KBD. So all these are definitely impacting prices at the moment. But we should remember we have the elephant in the room, which is Iran. All these can be impacting the market in the next few weeks. But as we start export cuts from Iran, that will take center stage for crude prices for rest of the year. I mean, we are really talking about a big number. We all know US is planning for zero exports from Iran, which means effectively, close to 2.5 million barrels per day of crude is at risk by year end. And looking at the spare capacity of other OPEC and non-OPEC producers, of meeting this supply shortfall, I mean, it's unlikely for them to bring such a big number online like so quickly by end year. So we think, the next 2-3 weeks, you'll continue to see the short-term factors like Libya, Canada coming back, impacting crude prices. But definitely we are bullish for the rest of the year with Iran taking the center stage after that.
Interesting. Parvai, the question would be, there will be opposing forces at play almost at any point of time. What's the medium term or the year-end trend looking like? Do you think through the year we stabilize or we stay on average above 70, or is it more likely to be centered around that $80 per barrel mark?
We think it could be around 75. I mean, but we could see a lot of bounce back between like 70 and 80, or even like 75 and 85. As you rightly mentioned, there are lots of stages which are, there are lots of factors which are, like fighting each other at this moment. We have a few bullish headlines counterveighing a lot of bearish supply side news. So this will be ongoing. I mean, this will definitely be there for a while before, some of the big supply related factors like Iran taking up a big drive to crude prices.
I believe, Shri, could be sometime around November. In the intermittent period wherein we don't have complete clarity on when does it go off, do you reckon that there could be some more downside pressure though? Or is this 5% gash that we've seen because of a raft of announcements that came in together is about it?
Yeah. Yes, I mean, it's really the timing. I mean, we saw both Libya and Canada coming back. So this definitely kind of overshadowed the other, big underlying support from Iran. And adding to that, the US-China tariffs definitely racked the market. So we think, it's really a lot of bearish factors coming together and like surpassing the bullish factors, which is more of a medium-term thing. Yeah.
Okay. Shri Parvai Karasu, thank you so much for taking the time out and joining us today and giving us your thoughts early morning.
Yeah, thank you.
That's the view from FGE. They believe crude could be centered around the $75 per barrel mark. Yes, there are some near-term pressures on the crude prices, but Iran going off the world supply chain could well put pressure back on crude prices on the upside. 75 is more likely to be the range around which crude could be centered at, which is actually not too bad news, to be honest. I mean, a lot of people, when crude reached 75 or 78, were worried that 85 could become the new normal very, very soon. That it may well happen. You never know with crude. But for now, it seems to be out of the window of sorts. And that's actually good news. Let's wait and watch if indeed we do see some more pressure on crude prices in today's session also or no. Remember, as I said at the start of the show, with crude doing what it is doing, while it's positive for the Indian markets by and large, let's watch out for some specific stocks as well. The OMCs, maybe even the paint stocks, the upstream names, all of these could be in focus. Speaking of paint companies, they are on the up with Asian Paints and Berger hitting fresh 52-week highs. What's working in the favor of the industry and what are the key risks at hand? Yash Upadhyay from our research team joins in with a quick synopsis. Yash, is this a GST story or is there more to it?
No, Neeraj, there's more to it actually. So the sharp rally that we've seen in these paint stocks in the month of July, that seems to be factoring in the positives of a healthy double-digit volume growth, of the expectation of a healthy double-digit volume growth in the first quarter of FY19, and also that possibility of GST being cut on the paint from 28% to 18%. Now, as we've seen in the first quarter of last fiscal, sales were disrupted significantly because of the implementation of GST. There was dealer-related destocking, and as a result of that we saw that volumes were impacted significantly, and on account of that low base, most of the brokerages, they believe that the domestic decorative paint volumes, they are likely to report a healthy double-digit growth. So something like an Asian Paints could see a volume growth of about 12% in the first quarter of FY19 on a base of about 2%. Similarly for Berger Paints and Kansai, which had done exceptionally well in that same period of reporting a 6% growth, that could also see a strong 10 to 12% kind of a growth in this quarter. Now, apart from that, there are multiple factors working there as well. Firstly, we are in 2018 with another year of normal monsoons is what the IMD has forecasted. Also, we've seen demand catching up significantly after 3 to 4 lean quarters. Demand came up with the fourth quarter numbers reporting with the fourth quarter the companies reporting a healthy double-digit volume growth, and also a pickup in construction activity courtesy the government's initiatives for housing for all and affordable housing. So all those factors, they seem to be working in favor for the demand in the sector. And also, well, as you rightly mentioned, the possibility of the government trimming down that list of goods and services in the uppermost tax bracket of 28%. Now, the industry had lobbied long and hard for the reduction of this GST rate to 18%, and that it seems is likely to happen sometime in this month. Now, with this, the effective tax burden for the paint companies, that is likely to drop from about 34.5% post the addition of cess and other duties on over and above the GST rate to about 23 to 24%. And now, as per the anti-profiteering laws, the companies would have to also reduce the prices, and that is expected to push volumes further. So all in all, these are the two key positives to watch out for. But also the key overhang remains the crude oil prices, which have run up significantly. And we know that crude oil prices, they are trading at fresh 4.5-year high. And also the other key raw materials such as titanium dioxide and other monomers and solvents, they have similarly seen a price inflation. And the higher the cost of these raw materials, the gross margins of these companies, they get impacted significantly. Also, valuations, that is one area where you're likely to receive mixed opinions, as all of them are trading at a significant premium to their historical averages. Take for instance Kansai Nerolac, that is the cheapest amongst the lot, but is also trading at a premium to its 2-year average PE. We caught up with Vineet Bolinchkar, who is the head of research at Ventura Securities. He seems to believe that while the valuations are expensive, they continue to remain positive overall on the demand outlook and the outlook for the sector going forward.
Interesting. Let's see what happens in Q1. Remember Yash, thanks for putting that into perspective. I remember the last quarter when Titan came out with some very good set of numbers. There was a big valuation gap between Asian Paints and Titan. Multiple There has to be, yes, but multiple reports that came out comparing how both of these consumption stocks have charted a very different course in the preceding 6 months. Things just seem to have turned around a little bit for both of those names, for individual reasons, of course. Let's wait and watch what quarter one throws up for these paint companies as well. We should know in about 15 odd days. Okay, we also need to know what quarter one throws up for Tata Elxsi. It's had a brilliant last 12 months. The stock surged 70% in just 1 year to trade at a record high currently. So what's setting the company apart, if something is? Darshan Mehta is standing by with a closer look at the business and what is it that is really working. Darshan, it's been a stellar rally, though I must say a lot of mid-cap IT companies have done it. But what's working for Tata Elxsi specifically?
Yeah, so basically there are a couple of things, valuations in terms of the return ratios, that actually plays in favor. Now valuation is slightly expensive because it's in a niche business, but nevertheless look at the return ratios. So basically if you're looking at the return on assets at this point of time, a 29% return on asset and return on equity of 37%. Valuations obviously much higher when the average IT company is trading anywhere between 20 to 25 times, PE of almost 32 times, and PE of 28 times on a 520 basis. So valuation is slightly expensive, but it's doing stuff, that is, and the growth is clearly coming, and that is helping Tata Elxsi. Now basically let's first identify what it does. 88% of the business comes in from the high margin software business, and this has been increasing. 12% of the business comes in from system integration. Now system integration is 12%, a majority is the software business, 88%. Now this is also subdivided into certain factors. So out of the software business, 77% of that 88 comes in from embedded product development, 9% comes from industrial design, and the balance 2% comes from visual lab. The majority business comes in from the embedded product development, which basically drives revenue. This is where the auto part actually comes in. So even if you break it up, how the 77% is broken up, you can see that 40% of the 77% is from the automotive business, which is high growing, 35% from the broadcast business, and the 25% from the communication business. So overall auto as a theme is very, very big, with the kind of innovative spends that is there on this is, if you take a look at the entire portfolio, so 60% of their revenues comes in from the auto business, 30% from the broadcast business, and 10% from the other business. So this is the high growth path for Tata Elxsi, wherein global R&D spends are going up significantly, and they are benefiting significantly from the auto spends. The other factors, what's working for Tata Elxsi at this point of time, they are earlier developing new technologies, and that is something that is working for them. And there is a strong contribution coming in from the IP business. This is just 5% of their business, but growing at a very rapid pace, and it's extremely high margin. So this is where they expect the new money to come in, and that will also probably drive revenues, at least for that time.
So do financials reflect key trends in Tata Elxsi, maybe automation, maybe some IP related revenues?
Yeah. So they have been doing well. If you take a look at what's happened, so we've taken the past 8 quarters to give you a significant example. They've been growing consistently. So while this period was a period of lull, for the last 2 or 3 quarters, they've managed to inch it up. The fourth quarter, on a quarter-on-quarter basis, they grew close to 15%. So the revenue trend seems to be on the upside. Even look at the profitability from a 41 crore PAT in the first quarter last year, last year, they managed to move it up to almost 70 crores here. So you can clearly see the increasing trend, and the last 4 quarters you can clearly see that there has been a substantial pickup as far as profits are concerned. They've also managed to maintain their margins above the 25% mark. So over the past few quarters, it has been done despite high capex this time around and a lot of investment. And the management says that the focus on FY19 will be to manage the EBITDA margins at these levels. So they're looking to maintain the margins at this level. The other important part is that you look at the cash flow that it has. This is the free cash flow. From a 38 crore free cash flow in FY13, they've moved up significantly. And this is where the move started. From 102 crore in FY16, they've got up the free cash flow to almost 316 crores. And this is where the money is coming in. And that's also reflecting on the stock price. So this is clearly working for Tata Elxsi. The other 2 things that pretty much work for Tata Elxsi is the rupee decline, it significantly helps them because they have substantial money coming in from the export market, and it's a dividend paying company since 2007. They also give a bonus in the meantime. So clearly it's a company that is rewarding shareholders.
Interesting. You summed up all the positives, Darshan, but we can't really not balance it out. What about the key risks?
Yeah, so there are two risks. Obviously, every business has risks. So first of all, if the rupee starts to again appreciate against the dollar, that could have an impact on the financial. As of now, everything is going great guns for them. The secondly is there is high dependence on certain clients. So that is something that they need to work on for, because you've seen risks like what happened with Wipro, that one client went bust and you saw the financials. Now the largest client that they have contributes 22%, the top 5 contribute 44%, and the top 10 contribute 57%. So the high dependence on just one client is a key risk. Obviously nothing's happened as of now, but you have to consider this as a risk.
Okay. We'll wait and watch. Thanks for putting that into perspective, Darshan. It's a standard disclosure from Bloomberg Quint. None of these are a recommendation. It's merely an analysis of what's been working for a company and what's not. Please do your own due diligence before you take a call, whether or not you want to invest in a stock or get out of a stock. It's completely left to the thought process of the viewer. The final piece on First Word today, and that's about road companies. 2018 has been a slightly tough year for road developers, with some of them trading almost 50 to 60% lower than the 2-year average. And this is despite the stream of order flows continuing. So what's weighing in on the sector and what lies ahead? Nikki's tried to put together an analysis. Nikki, this does come as a surprise, right? Normally we've seen road companies only getting orders. It's a big surprise that some of the companies are trading at substantial discounts. What's happening here?
Totally. If you look at the project awarding and historic levels, and if you look at the valuation and the share prices, they seem to be a different picture. Let's look at the share price level. Most of these companies have cracked anywhere between 20 to 40% on year-to-date basis, while the valuations of these companies are trading at a discount of the 2-year average PE. With the discount being the maximum for players like NCC, almost 60% there, PNC Infra, KNR Construction, too, trading at a 40% discount to the 2-year average PE. So clearly we're seeing some kind of discrepancy with the project awarding and the kind of share prices and the valuation that these companies are demanding right now. The same has been the scenario for Dilip Buildcon, Simplex Infra, Ahluwalia, NBCC. They all are trading at a 2-year, below the 2-year average PE at the current multiples. So what's really ailing or weighing on these stocks right now? Well, the first one is the lack of clarity domestically on account of the political environment that we have until FY20. That's weighing on these stocks. Also, if you look at the global uncertainty, given the trade war scenario, most of the investors there are taking a flight of safety from these equity asset class. So that is one thing which is also not working well in the favor of these stocks. Apart from that, you have risk of a project funding, which continues to remain on the sector as an overhang. Also, if you look at the fourth point, which is the rising interest rate scenario, definitely doesn't augur well for rate sensitive stocks like infra, and the concentration of business in the hands of few, or maybe the few players which have backed most of the new orders, also doesn't work well for the sector as a whole, Neeraj.
Okay, but the government projects at having been awarding projects or awarding orders at a very healthy clip, Nikki.
Sure. If you look at, if you remember, we're having a conversation back at the end of the FY18 where NHAI delivered the historically high project awarding. That momentum continues, but then obviously the pace has receded a little bit, given that the first 3 to 6 months of any given financial year is a lull period. But in terms of the kilometers that have been awarded, it stands at 892 as against 17,055 kilometers which had been awarded back in FY18. But
Nikki? I mean, generally the pace was anyways considered to be strong. HAM projects, etc., all of them are leading to higher awardees. Why this sudden dip?
So usually the first 6 months of any given financial year usually seems to be a little slow pace or the lull period for most of the infra players, because the government usually focuses on, or maybe in the last quarter also we saw the project awarding actually coming through in Q3 and Q4. So something similar trend can be expected in this financial year. Having said that, Neeraj, I'd also like to point out about the construction pace right now, which continues to outdoes the project awarding pace. Currently, in Q1 FY19, that is the April to June period, we're seeing the kilometers that have been awarded at 2,345 as compared to the 900 kilometers which have been awarded back in Q1 FY19. So we're seeing some kind of outpace of construction as compared to the awarding, given the time of execution that the players usually take, which is in the span of 3 to 6 months. Also, I'd like to point out a few things which are going right for the industry right now. The new government initiatives, also NHAI has done a lot in terms of fastening the process for land acquisition. That's definitely auguring well for these players. Apart from that, I'd like to highlight the success that TOT projects have done in terms of easing the funding. We've seen, if you look at the pie chart, that we have 5% of monetization from national highways is what the Bharat Mala project is funding, which is through TOT route. Given that the success that we've seen in the first round of bidding for TOT route, we're estimating that the Bharat Mala project would be able to fetch more than 5%, which in turn will ease the balance sheet pressure from NHAI and will help it to execute the projects faster.
Okay, well, Nikki, thanks for putting that into perspective. Hopefully, Q2, Q3 onwards, the pace of project awarding could also pick up. But I must say, FY18 was one terrific year in terms of road projects being awarded through various models. We already know about how the pace of, how the quantum of HAM projects went up. TOT, that whole Macquarie order that went out of about close to 8,000 or 9,000 crores was one key element which lifted the spirits as well. So you have various kinds of players now coming in. It's not restricted to the top 3 or 4 players when it comes to road projects getting won. That's all that we have on First Word today, though. But a quick programming note, a bit later on, we'll talk about how higher minimum support prices have prompted CLSA to bet on the consumer stocks, that and more, with India strategist Mahesh Nandurkar, and how this year's monsoon is changing fortunes for select companies. Bharat Rasayan, the stock is up about 20% in the last 1 month alone in a sideways market. The president of the company, Abhishek Aggarwal, joins in to talk about what the company does and how the outlook ahead could be like. But for now, we take a quick break. After this break, full tilt towards today's trade.
Sorry, I'm late. क्या हुआ?
कुछ नहीं यार. Just working on my expansion plan.
Funding का चक्कर.
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख. ला.
अरे.
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
Interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल.
हाँ.
NSE Emerge, साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that is sustained.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Welcome back. You're watching Indian Open. Well, the Asian markets at this point in time are showing a lot of strength, with the Nikkei along with the Shanghai and the Hang Seng advancing. In fact, 1% gains for the Nikkei and the Shanghai. Hang Seng up as much as 0.4%. Where does that take the SGX Nifty at this point in time? Well, indications are inching back towards the mark of 11,000. As you can see, about 0.3% increase coming in for the SGX Nifty too. That said, what are the cues that the futures and options space are throwing up for us this morning? We have Navneet Saluja joining us to give us an idea. Navneet, good morning.
Good morning, Agam. Well, it's looking like a good Thursday morning. In fact, across the Asian screen, as Agam highlighted, we've seen some positive ticks, and SGX Nifty 2 suggesting an 11,000 mark. Let's see if we can touch that or not. But yesterday, the Nifty futures, yesterday was a flat trading session after gains that we saw on Monday and Tuesday. So the futures closed at a discount of almost 10 points. Open interest went up by about 3%. If you look at Bank Nifty, remember today's Thursday, so that's going to be in focus as the Bank Nifty weekly options expiry take place. The range you can watch out for the expiry will be 26,600 on the downside to about 27,000 on the upside. That's where the maximum open interest is so far for Bank Nifty. Yesterday, however, there was some unwinding definitely seen as the open interest was down nearly 7%. What's supporting this market is low volatility. But yesterday, we did see the India VIX actually inching higher, but still, it is not at alarming levels. So it's fine to be somewhere between that range of 12 to 13. On that note, let's also tell you what the PCR looked like. So no major changes actually, but still put riding continued. So Nifty PCR went up to levels of 1.66 and Bank Nifty was at about 1.11. So let's tell you which were the strikes that contributed to that gain. Put riding continued at 800 and 900 and 11,000 call yesterday was quite active. Remember, that's also the strike on the call side where maximum open interest is. So in case if we touch the 11,000 mark, be ready to see some sort of unwinding coming in on the call side from the call writers. In terms of FI data, remember if throughout this week, in the last 3 sessions, we've been getting positive cues. Yesterday also they created more of long positions and unbound shorts. So that's some positive cues coming in from FIs after a really long time. On the index options front, however, there was some unwinding seen, but today being the options expiry day, we did see some hedging on the put long and the put short side.
So this is Navneet as far as the options and the index strategy goes. What about specific stocks? Have some come into the ban? What have been the positions built up on specific names?
Well, a lot of stock futures and Neeraj to keep an eye on. Let me start out with the biggie itself. That's TCS. There was some short covering definitely seen on the future side as the stock surged. So let's see whether that buying momentum continues today or not, because I believe the delivery data was on the higher side. The other stock probably to keep an eye on will be Ramco, where fresh short positions were seen. And I'll be watching out for ITBI Bank. The stock's up 18% this week. Short covering was seen as the open interest fell 11%. If you look at the total open interest as a percentage of MWPL, it's fallen from 100% to 80% this week. So in all likelihood, it could come out of the F&O band today. And let's see whether that happens or not. But the data is indicating, so watch out for IDBI Bank. It was up 6% yesterday as well.
Well, I'm actually looking at TCS delivery volumes at this point in time. Firstly, the volumes themselves stand out. This is the traded volumes, the total traded volumes at around, well, I'm looking at around 2.29 crore shares, and the delivery volume standing at around 40%. So if I'm not mistaken, as per the calculations, nearly 1,800 crores worth of TCS shares were taken as delivery in yesterday's day of trade, with that sharp surge coming in. So while there was short covering yesterday, let's wait and watch whether or not this strength continues and we start to see some longs building up in TCS, or perhaps we could see some profit taking. But the probability is certainly on the higher side. Likelihood of TCS, well, perhaps moving towards the mark of 2,000, considering we saw it end at 1980 yesterday. Let's see, wait and watch whether or not we do see that strength come through. But it's certainly been the stock of the day when it comes to trade yesterday, Neeraj.
You bet. So yeah, 1,700, 1,800 crores worth of buying. FI is putting in 625 crores. I know you can't really correlate both, but I'm somehow tempted to believe that some bit of that FI buying, or a large portion of that FI buying, could also be in part due to what's happened out there. Let's focus on all of these with Sameet Kalra. He's founder at Target Investing, joining us right now on the show. Sameet, just a brief trend question first. Almost everybody who's been a fundamental analyst or a fundamental watcher would have found it hard to believe that with all that's happened in the recent past 6 or 7 weeks, we could have a sudden and swift breakup on the upside. We've seen that happen this week, and despite the global markets looking slightly patchy yesterday, we sustained, and now crude has fallen, which probably gives more ammo to the machinery. Are you surprised as well, or are you tempted now to put some fresh gunpowder to work?
So we were not surprised.
You expected this?
See what happens when the Jan, Feb, March, when the Jan top came and Feb and March got drastic selling. That was mainly due to long-term capital gains checks coming in, right? April, the bounce back slightly came back. What we were expecting that this to happen in maybe September or October, pre-elections, where there's an upside and certain people want to exit and they exit out, and all these aberrations get out of on the downside. Secondly, what happened in meanwhile is a lot of algos took over. So if you see in past 5 days, forget about 5 to 6 days, the upside in past 5 to 6 days has been more drastic on the upside. And that has been on the global front as well. That hasn't been replicated. Even if you forget the yesterday part, yesterday was down on the global front and we were kind of positive. But if you remove the TCS move, we were still negative. So what happened on the shorter term, the algos dominate the situation. And there were no escalations as such after the implementation of that 34 billion trade war import tariffs.
True.
So the escalation only came on the warning sides for the September implementation. So I think over there the algos took over and they were kind of a buying which was happening on the futures end of S&P, Dow Jones and the global.
So what's the thesis then? Is this short-lived or will we?
So this should be a short-lived one. We should see another downside coming, but yeah, because see what has happened, that 5% crude oil which happened last night was mainly due to Libya OPEC data coming up. So there were a lot of factors at one point which gave that helping hand. So that's why the 6% downside came in, but we are already 1.5% up from that level.
Okay, I just have a quick follow-up then, in which case, I'm sure Agam has more questions too, but in light of this, just a tactical trade, is there a tactical trade in some of the oil sensitives, the likes of oil marketing companies which have been beaten down the last few days? Do they show a bit of a bounce because of the crude drop?
Yeah, so I think we believe July, August and September you'll see a downside to crude prices, given two reasons. One is as the OPEC data comes in monthly, there will be a higher increase of the output. And Saudi is being given the domination of that increase in output. How the OPEC as whole reacts, that is yet to be seen. But on the upside risk from the October onwards, we see the risk to the Iran exports. That's a very big upside risk in that system. And Venezuela is still dropping. So till September, I believe this crude prices will come down. So OMCs are the place to be for buying these because they've already beaten down quite drastically. And we believe till next 3 months you can see an upside on OMCs.
All right, so Sameet, I'm not going to consider Reliance in this because it's a case of a mixture of a lot of businesses now, but what does it mean for something like an ONGC at this point in time?
So see, we've been buying ONGC at all the drops. Because we believe the short-lived, downside to the crude, while we believe there's a long-side risk to the crude.
Right.
And that will be very drastic if the Iran sanctions come in place, and even if the 50% exports get reduced, and even if Saudi is able to, get into that supply gap, the only point is the spare capacity is the issue for the whole OPEC as such.
Right.
And I believe that if that happens, the upside can be around $90, $95 or $100 we can see back.
Right.
But that's an upside risk. ONGC, what is happening, what is troubling them is the subsidy issue, is the HPCL buy, which has created a cash flow issue. So I think these will be sorted out by January next year, because they have a repayment of 80% of the loan which they have taken. So I think over there they will do some mergers and restructuring before that happens to better their cash flows.
All right, Sameet, hold that thought. There are plenty of stocks that we need to keep an eye on in going into today's day of trade. And we take stock of some of these counters that will be in focus on the back of news and, of course, several other developments that we've had. And we have a research team once again joining us. Good morning, guys. Shraddha, what's on your list when it comes to news?
Probably not too many big movers, but you have Cipla, which has made an acquisition in South Africa worth 228 crores. Forgings will issue bonus shares in the ratio of 1:1. Omax Limited will be in focus. They've received a project for reconstruction of a multi-level car parking space. Not sure how that will react. You also have Eris Life Sciences, All Cargo Logistics, Finolex Industries, which will be meeting investors today, so keep an eye out for those names. Century Enca Promoter Group has sold 1.8% stake on July 9, so that's based on insider trades that were reported on July 11, so watch out for that name. You could see some negative reaction there possibly. And of course you have signed Karnataka Bank and Talwarkar's Lifestyle Agamma, which report their earnings today.
All right, and a bunch of brokering notes as well. This morning we have Tata Steel in focus. Sameet, what do we have on this one?
So in their investor meet with IDFC Securities, the Tata Steel management said that they will continue their growth opportunity plans in India because they have a clear vision to take their total capacity to 24 million tons per annum by financial year 2022. Now the company currently has an excess iron ore supply of close to 3 million tons per annum, which the company is looking to supply to Bhushan Steel plants, and they're currently working with the regulatory authorities on this because it will further help them boost their consolidated EBITDA of the company. Now on the balance sheet side, the company said that they are highly leveraged with a net debt of close to 1 lakh crore rupees, but the company is saying that they're capable of servicing this debt, and the target net debt to EBITDA is close to 3 to 3.5 times over a long-term period. Now on the back of this, and given the current share price levels of Tata Steel, the brokerage, that is IDFC Securities, is saying that the current price levels are capturing in all the negatives that are related to Tata Steel, and they advise to buy at current levels and also to buy at declines on Tata Steel.
All right, and in another broking note, we also have HEG in focus. Nikki, what do you have for us?
Morning, Agam. Well, HEG held a roadshow where 20 investors met the management, and the key takeaways which Jefferies has put out is where they've maintained the buy rating and the target price of 4,400, indicating a potential upside of 12%. It says that the realization, the management says that the realization is expected to remain robust, and they expect the utilization levels to go higher here on, given the availability of needle coke, which is the key raw material used in the production of graphite electrodes, given that the largest producer is now debottlenecking needle coke, which is expected to increase the integrant. Apart from that, you have graphite electrode demand, which is expected to go higher within China, which is also expected to go well for the company. HEG management, in terms of cash utilization, has said that they expect the capacity to expand by 20 KT, and they've earmarked a capex of around $100 million for this for a span of 2 to 3 years. They've also indicated they're looking at different avenues within carbon space for cash utilization, and have suggested that they're going to be maintaining least payout ratio going forward.
Okay, thank you guys for joining us and giving us those updates. Sameet, if I can take the matter of HEG and graphite with you, how are you assessing the way the price movements have panned out in the recent past few weeks, keeping in mind the fundamentals at this point in time?
See, fundamental wise, I was negative on them 6 months back, so I might be being proven wrong for today as well. See, what is happening is majorly the capacity expansions are not there. So they are getting the benefit of the capacities being shut in China and the prices being still up. So a lot of commodities have corrected, but these are places where the correction has not come. So I believe that there might still be an upside because it's related to price correction or the price movement coming in. And whenever that correction comes, then only they'll see any corrections. Otherwise, the YOY base will still be a stronger performance till the capacity runs out. So I think that should be another 3 to 4 quarters.
So, but you're saying there is a fundamental case for the next 3 to 4 quarters to look good for HEG and graphite.
Yeah,
right?
but now if you're entering, you have to be very careful on the electrode prices which they are gaining. So if any news comes in of a Chinese capacities coming back, because what is happening, a lot of factories which are closed past 6 or 12 months are complying with the new environmental norms.
Okay.
And slowly these capacities are coming back.
Has any capacity come on stream
as of
in the
now,
last 6
no.
months? Okay.
No, for them, no. And for them, what is the beneficiary is that a lot of global capacities in Japan and Germany. In Germany, 1 or 2 capacities face a closure. So that is keeping the price of the products up. So I think any kind of a news, and these are stocks which overnight will turn. So
yeah, sure, but
because
I'm just trying to figure out a capacity coming on stream, which has not come on stream till now, is still a few months away, right?
Yeah.
We don't have a handle on when they will come on stream.
No. Right now, see, the only point is I still believe that the 3 to 4 quarters will be a place where some kind of capacity comes back.
Okay.
I'm not seeing it happen in the next 3 months or 4 months, because if it had to happen, the globally restarting takes a little 2 to 2.5 months for the approvals in China to come in for the factory to restart. So I am not seeing anything for past 3 to 4 months.
Interesting. But almost everybody, I'm fairly bullish. I mean, I have on Twitter as well, a bunch of people talking about how electrode prices, spot prices versus future prices and the difference thereof. Or Jefferies, which was, I believe, one of the first ones to come out with the notes amongst the larger brokerages.
Right.
Still remaining bullish at 4,400. I think the management commentary 3 or 4 days ago was also extremely bullish. They didn't sound any words of serious caution.
Yeah, and I'm actually looking at the analyst ratings on the Bloomberg consensus as well, both for graphite as well as HEG. There aren't too many analysts who track these counters at this point in time. Of course, Jefferies changed that substantially for both these counters, but still, for HEG, there are 4 analysts, all 4 analysts with a buy call on this one, and of course, the graphite as well. 5 out of 7 have a buy call on this one. So the consensus at this point in time is certainly very constructive on graphite and HEG. But that said, some concerns that Sameet has also spoken about are absolutely valid at this point in time.
Well, Sameet, stay on, so much more to talk about. Let's dwell a bit on technicals and derivatives and trade today. Sameet Chavan, he's Chief Analyst for Technical and Derivatives at Angel Broking, joins us right now on the show. As does Rahul Mohindar, Director at Viratech Software, with us on the show as well. Gentlemen, both of you, very good morning. Many thanks for joining in. Sameet, the last 3 days, both Navneet and Agam tell me that the bent of the FIIs has been on the long side on the index futures. That didn't change yesterday either. And we likely having a bit of a leg up because of crude price fall. How would your index strategy be at this point of time?
Yes, initially we witnessed some kind of consolidation, but since last 3 days, market has picked up some kind of momentum after surpassing its recent level of 10,800. If you look at the option activities, 10,700, 10,800 put writers were quite active. So that clearly indicates that the earlier base, which was around 10,500, 10,550, has now shifted higher. So 10,800 would act as an immediate support level. So we believe that one should trade with a positive bias. And yesterday also we did see some kind of outperformance as compared to its global peers. So we believe that market is likely to remain in some kind of range, but it would trade with a positive bias. So any minor dip would be a good buying opportunity. But we don't expect any runaway rally as such. So immediately you'll have a resistance of around 11,000, 11,050. But within this, you'll have a lot of individual stocks, that will give decent trading opportunities. So one should trade with a positive bias for the day. 10,900, 920 would act as a very strong support.
Okay, Rahul, good morning to you as well. Do you think 11,000 is a possibility? Of course, it's not too far away from current market levels, but is it likely that Nifty could move above the mark of 11,000 in the near term and perhaps remain there for some time to come? Or do you see some caution setting in at this point in time?
I think the market is really, if I could put a phrase to it, cautiously optimistic, and that's not a bad thing at all. We've taken continuous drops, and every week that I've come on the show, I've been mentioning very categorically that long term we're structurally intact. Even the medium term trend is structurally intact. It's just that the market took its time over the last 1 month before it started to surge up again. Now, is it going to be a rally that we saw like in the month of April or May, where we had that straight line run of 800 points on the Nifty from, broadly 10,000 to 10,800? No, I don't think we're really in that cruise control mode. There are a lot of block holes as we approach the new high. But to answer you clearly, yes, we do believe 11,100 is a near-term target. Will the market sustain past 11,000? That's very tough to say. I think the market will take strong consolidation or pauses. So even right now, if someone is looking at this market very, very short term, more from a 1 to 2 day kind of perspective, the immediate number that would worry me is the fact that 10,980, that's near term resistance. But broadly, if you can wait it out over a few weeks, we should see 11,100, and I'm fairly confident that the trend remains intact. And I'd agree that 10,800, very strong support for the Nifty. So keep that as the new number before you review the trend.
Interesting. I think the sum and substance of what both our experts are saying, one is, of course, don't even think of a short, but if you are long, there is no real worry to really square your longs in a hurry. Maybe a trailing stop could be a better bet as well. At least that's the sum and substance of the commentary this morning, as well as last afternoon. Almost all the guests, the three guests who were there on the platform, were all speaking about how continuation of longs might be a better strategy as opposed to trying to think about anything else. We'll get in some stock specific ideas in just moments from now as well, but it's 8:50, so it's time of the show wherein we get our special segment Bloomberg Edge, and Jayesh Khilani tells us about a pattern that the terminal is thrown up on a stock, on an asset class. In today's case, it is a stock. Jayesh, what's the stock on your radar today?
Morning, Neeraj. It's United Breweries. That is because the stock has in fact bounced back from the 100-day moving average, and with yesterday's close it has in fact breached above the 50-day moving average as well. The other interesting bit that has happened is the fear and greed, which is a proprietary Bloomberg indicator, that has turned positive, thereby giving a buy signal on theory. Let's first have a look at the fear and greed and how the indicator works. Like I was telling you, it's a proprietary Bloomberg indicator, and it uses the spread of two weighted moving averages of the concept of true range. It oscillates on a zero baseline and therefore becomes very simple to interpret. All you have to do is follow the color. Red is indicative of sell and green is indicative of buy. Let's have a look at the chart of United Breweries. That's the last 6-month chart that I was talking about, and you can see that this range where the 1100 to 1150 mark is, this is close to where the 100-day moving average is, and with yesterday's close, it's very just above the 50-day moving average as well. And the bottom panel shows you the fear and greed indicator. If we zoom into this, you can see that after after the red bars, yesterday's close has been positive, which gives it a buy signal as per the theory.
And how has the indicator done historically, Jayesh?
Agam, worked reasonably well. Last 1 year, the net profit on a backtesting basis would be just in excess of about 20-21%.
Okay, fair enough. Watch out for United Breweries then. But Sameet, coming back to you, what are the ideas that you're playing with in today's day of trade?
See, considering yesterday's action, it is quite clear that we may not have unidirectional move in all these stocks. So there could be stocks that could offer you better shorting opportunity. There would be stocks that are giving decent bounce back. So on the long side, we have Divi's Lab. Certainly looks good. It has been consolidating of late, and yesterday there was a decisive breakout in the latter half with substantial rise in volume. So we expect continuation of this move. 1167 would be a near-term target. So one can go long with a stop loss of 1096. Our short idea would be on McDowell. After nearly 8 to 10 months, this stock slipped below its 200-day moving average for the first time last week. And since last couple of days, we have been recommending shorts somewhere around 640, 645 with an anticipation of a breakdown. Yesterday, toward the fag end of the day, we did witness some kind of selling pressure in this counter, and the stock is now on the verge of giving a breakdown. So we would recommend going short on McDowell for a target of 585. Stop loss would be around 639.
Interesting. There were some short positions yesterday on United Spirits as well. The terminal indicator on United Breweries is slightly different as well. So it's chalk and cheese amongst the liquor names, and there would be the case the input costs and other factors are slightly different. But Rahul, what are your stock specific recommendations for the morning?
I think one of the stocks that has stood out in the past week and the last few days has been Reliance Industries. Huge rally that we've seen, very good volumes coupled with it. really into kind of a new high zone. So I think we'll continue throttle there. This is a very important stock if the index has to move up further. So even at the current levels, I think we are headed for more. My target on the stock is 1,075, and it may not come today, it may not come in 2 or 3 days, but over a week or so, I do think we'll be heading to about 1,070, 80 levels. I keep a stop loss at 1,015 and buy Reliance, hoping the outperforming continues. The other one is Dr. Reddy's, and pharma seems to be actually interesting play altogether, but why specifically Dr. Reddy's is over the last 2 or 3 weeks, we've been observing a lot of support around 2250, 60, and some consolidation of volume also around that level. So between 2300 and 2250 broadly, there's a lot of volume factoring, a lot of consolidation that's been happening. We are positive medium term on the stock, but if you're a short-term trader, in a few days you probably will see 2400. That's our call. So I'd buy the stock with a 20-30 stop loss. If you're willing to push this a little more and hold on for 6 to 8 months too, I think it's a very tradable bet.
Okay, let's take an all-around view of TCS. Let's do a technical check and perhaps get a fundamental view on it as well. Rahul, yesterday perhaps may have changed the scenario for TCS considering the surge in volumes and the sharp up move as well. But we also have the matter of the buyback in place, which is around the corner. Keeping some of these factors in mind, how are you viewing trade on TCS? Can we expect more strength to come through? And in that case, what levels would you be keeping an eye on?
I think TCS is a classic case where you see the stock is really outperforming the market. It's not worried about the index, or for that matter, its peers. It's done a lot better than most of the tech stocks. In such a scenario, what we typically recommend on a technical basis is to continue to hold a stock with a trailing stop. And the buyback would not deter me, would not worry me at this stage. You will see bouts of volatility, but I think at this point, keeping a level of 1850 in mind, one should continue holding the stock. The question is, can I even come in and buy the stock? From a short-term perspective, you can. I mean, you can certainly bet that the stock will outperform. And those of you who are attempting to day trade, I would really look at coming to 1920 to 1940. That's a spot I'd like to buy it, keeping a tight stop loss at about 1875. So you can continue hoping for more from TCS. I think there's still more to come, but its peers too may participate in this rally, but again, I would continue to believe that TCS is going to be the outperformer.
Okay, so with that, Sameet, I'd like your view on what you made of the earnings. They've clearly beaten consensus expectations. One, your take on TCS earnings, and on the back of TCS earnings, what can we expect from the other large caps?
So if you see TCS earnings, even the constant currency give them a big leg up on the revenue side. So the deal wins which they have done in past 6 months, that is now coming into the revenue generation and beating the expectations. So I think this trend will continue for at least just 6 months or 12 months, because these deals are new and they are not in the base. So that base effect will continue for 6 to 12 months. That against the helping of the currency getting devalued. So that was another leg up to the whole numbers. If you see the attrition wise, they have controlled it very much now. The onshore hiring in the US has picked up a lot of space. The H1 visas are almost same as issued last year, which was a 30% drop from last year, previous to last year. So I think now the stabilization in the systems, or the operational stabilizations, are coming in, and all the fears of H1 visa issues and all are going away from the stock prices, which were there in the stock prices, not in the fundamentals of the firm. So I think somewhere both are matching now. There might be a certain overvaluation in the large cap firms, because if I see that kind of a safe haven, and even the pharma facing kind of a regulation issue still. So I think they have reduced it to IT and consumer staples. So that's where the large caps are facing much more upside and getting overvalued in a certain sense.
Yeah. But this is not, I mean, from past instances, you could argue that TCS might be overvalued, but the largest IT company throwing in dollops of cash almost every quarter, still on a PE basis, a substantial discount to some of the consumer names.
No, I see.
Apple comparison.
We prefer them up. We were holding Infosys and TCS as our top holding.
Oh, really?
We've reduced a certain weightage on it and brought it down to the middle of portfolio. I'll give you two reasons, because the whole upside to that surprise and the prices of the stocks were there when all the negatives are there.
True.
So now when everyone becomes positive, it's only the quarterly performances which can push the leg up. And that gives you a big gap of any downside risk coming in.
Yeah.
So I don't see anything troubling for 6 to 12 months. And to the valuations, yes, they are very cheap as compared to consumer staples. So I think over there is a leg up still there.
Right. Well, we just about 10 seconds left for pre-open. So at this point in time, let's take stock of what's going on in the Asian markets, all advancing. The picture hasn't changed, and it's the same for the SGX Nifty, up by as much as 0.3%. What does it mean for our own markets? In pre-open, subdued opening, but now we're starting to see some strength. So our indices are taking cues from the other Asian indices. At this point in time, indications of the Nifty above 11,000, and when it comes to the Sensex at around 36,300, up as much as 0.2%. There's more strength coming on the Nifty at this point in time. Let's take a look at some of these counters then. Let's take a look at Reliance first. One of the key movers, and we have seen some strength come through over the previous few days. Reliance is up as much as 0.6%. TCS is the other one, and let's just see whether or not we can expect more strength in today's day of trade, up as much as about 0.5%. Hindustan Unilever trading at lifetime highs, above the mark of 1700 yesterday. Indications of a 2% increase, which means that it likely move above the mark of 1750. And Bajaj Auto was the other one, which also showed a lot of strength yesterday. Can we expect more strength today? Yes, up as much as 0.7%. On the losing end, I just want to mark UPL because there has been substantial weakness. One of the few Nifty counters at 52-week lows. It's likely to see some short covering in today's day of trade at around 609. And Coal India was the other one which saw substantial weakness yesterday. Can we see a little bit of recovery? Possibly. That really cannot give us a determined rate at this point in time. And Tata Steel, of course, we had a brokerage note come through this morning. Let's see whether or not we can expect Tata Steel to advance in today's day of trade. Yes, possibly, as per indications of a 2% increase in today's day of trade. What else are we tracking, Neeraj?
Well, it has to be OMCs, to be honest. I mean, the oil sensitives would be the ones that everybody would be watching out for. BP, HPRC, just keep an eye out for those names. Even on the Nifty 500, those are the ones that are really ruling the roost. I must say, there has been a smart comeback by Dilip Bildkon the last 4 or 5 days. Another day of gains, about 2 or 3% in the first few ticks of the pre-open session. Ashoka Bildkon has this big unnatural uptick, 16%. Reckon that might change a bit, but let's wait and watch. And IGL, no, I don't think there'll be a 9% uptick out there. HCL Tech, again, a freak trade right now. No information come out as yet, right? We'll probably get to know about it only during the course of the day or maybe post-trade. So HCL Tech too.
HCL Tech will be considering a buyback today.
Yeah, so but those details will probably come out only post-market hours today. So let's wait and watch. It might be too premature to expect anything out here if you haven't done that the last couple of days. Anyways, let's wait and watch. The rupee should come up on your screen as well. 68.77 was the trade yesterday. Let's see what it's doing right now. 68.67. So a bit of a pullback on the rupee, and the bond yields 7.90 was where it opened yesterday. 7.82. So pullback in trade yesterday as well on the yields. So bond prices have had a bit of a relief the last couple of trading sessions. Okay, we'll analyze more rates in a bit. But before we do more rates and take in some technical opinion from our experts, it's also important to highlight one key release of data. It's not easy to take on a behemoth like Life Insurance Corporation of India, and the first couple of months of this fiscal, private insurers did suffer in bits and pieces, but they've managed to reclaim some of the lost ground in the month gone by, that is the month of June. LIC's market share dropped below the 50% mark as private insurers managed to post double-digit growth in the new policies. Yatin Mota is here to put in some perspective. Yatin, maybe a relative low base for companies like ICICI Pru helped, but a bit of a relief month, the month of June, compared to the previous two.
Yeah, clearly, Neeraj, in terms of market share, and if you look at the performance of the private insurers versus LIC, they have been able to gain some market share. Of course, LIC consistently has been losing market share. But if you look at the YTD market share of LIC versus the June figures, clearly, we'll see a trend wherein the private insurers have really done well. In fact, if you look at, the chart which is coming up, and the kind of market share that we are looking at for LIC, they had been around 50% plus for FY 15 to FY 18 period first half, but in the second half of FY 18 to FY 19 YTD, we have seen the market share remain below 50%, and more importantly, every a month coming in, we have the private insurers which have been doing well. Of course, the digital transactions and the kind of network that the private insurers have been able to build has been aiding their overall market share performance. But if you look at the for the month of June 18, the growth also has been quite strong for the private insurance space. We have seen a total growth of nearly 15% of in terms of premium collections on a year-on-year basis for the private insurers. However, if you look at LIC, the decline has been 3.5%. So clearly, the market share which has been turning, that is largely to do with the fact that 15.5% growth for the private insurers, but a negative 3.5% for LIC. What's not done well in the private insurance space is ICICI Pru. Their growth has been flat for the month of June 18. However, if you look at the likes of SBI Life, they have done an 8% growth. HDFC Standard Life continues to do well. They have done a growth of nearly 12.8% in the month of June. Max Life, of course, the base is smaller, but a 22% growth seen there. If you look at Kotak also, the base is small. They have done a 70% growth, but look at Bajaj Allianz and Birla Sun Life. Bajaj Allianz doing a growth of nearly 9.4%, and Birla Sun Life doing a growth of 57%. Of course, this is largely to do with the kind of digital push that I have been talking about. And also, if you look at the market share, we have seen a good amount of growth coming in for SBI Life, HDFC Standard and Max Life, and this is broadly the kind of growth that we are talking about. So two large players, LIC and ICICI Pru, were the ones which have seen some negative growth. But on an overall basis, if you look at SBI Life, HDFC Standard, Max, Birla Sun Life, all of those top 5 private insurers, they have done strong double-digit growths.
This is interesting. Yatin, thanks for putting this into perspective. This is interesting because ICICI Pru had the benefit of a low base as well. June 2017 was just a 27% growth. They were expected to grow after not having a great month in the month of May, but they have kind of failed to do that. But interesting, HDFC Life, the juggernaut rolls on, and what they had lost ground in the months of April and May, some private insurers seem to have reclaimed some bit of that lost ground as well, which is very good. However, as the first pre-open rates are settling down, we're seeing some bit of traction in the oil marketing companies, as we said. Principal gainers, companies like Jet Airways and a few others too have done well. Sameet, Chavan, initial thought, BP, HP, IRC starting off with a bang. Could there be some trades here now after we already seen a bump up of 3, 4, 5% apiece?
We have already seen massive correction in most of the OMCs as far as HPCL is concerned, that we have been closely tracking. 240, 250 according to us should have acted as a very strong support, but we have already seen a decent recovery, and today we are witnessing a gap up opening. So 280 is the level to watch out for. If the stock manages to sustain above those levels, then it is heading towards 300. But first half an hour, 1 hour closing beyond 280 is quite crucial. If that happens, then yes, one can go long by keeping a small stop loss somewhere around 272, and in that case we could see a decent move towards 300, 302.
Okay, can we also pull up Hindustan Unilever and see where that is at this point in time, at least with respect to its pre-open rates at 1720. Substantial strength coming through over the previous few days, currently at lifetime highs. Rahul, is it time to remain cautious, at least in the near term, even though I suspect that the charts in the long term would suggest, an up move? In the near term, do you feel that the stock just may have been overbought, or are you still gung-ho and would suggest fresh longs at this point in time for Hindustan Unilever?
No, I would not recommend fresh longs on the stock. And there are a couple of things. Yes, it's in uncharted territory, and again, it's a story like TCS where I'd say it's a strong stock. Just because it's overbought, it doesn't mean that it's going to collapse. What you need to do is bring in a trailing stop loss and continue to hold. So in stocks like this, I would say, unless 1670 breaks down on a daily close, do not pull out of long positions. Yet if you're looking to buy them, look at drops to buy them. I wouldn't think that you're going to, this is a prudent point to buy them. Intraday, yes, I do expect resistance between 1740, 1760. So it'll be interesting to see if we can really surpass those levels.
Interesting. Well, so the pre-open rate certainly pointing towards some bit of an uptick. Just wondering very quickly before we get in all you need to know, Rahul, Mohindar, would you trade the Nifty Bank today? It's likely to start off about 0.5% higher.
Well, I think it's a mixed bag in the bank. Stock like SBI still hasn't got out of the woods. It's a totally mixed bag there. You look at some of the private sector banks, they would probably move up, say an ICICI or an Axis, but there are several in the balancing act. So to answer I would not attempt taking a trade on the Bank Nifty at this point in time. I still think we would.
Okay. So not taking a trade on the Nifty Bank. I'll take this question to Sameet Chavan as well in moments from now, but it's 4 minutes left for the markets to kickstart trade. Let's tell you all that you need to know to stay ahead in trade today. First up, oil marketing companies will be in focus today as crude prices fell 6% overnight, likely to start off on a positive note.
And lead prices saw an overnight fall of 5%. Battery makers like Exide and Amara Raja will be in the spotlight.
Cyient, Karnataka Bank and Talwarkar Lifestyles will report their June quarter numbers today.
The Vodafone Idea merger faces some more delay. Idea Cellular says that the Department of Telecom's approval for the merger is conditional and not final.
Siplago Shopping, the company's wholly owned subsidiary, has acquired a South Africa-based company, Miren, for 228 crore rupees.
And shareholders of Forgings will be a happy bunch. The company plans to issue bonus shares in the ratio of 1:1.
Small reactions thereof on Forgings. But battery makers, we were doing some analysis yesterday as well. Lead prices have fallen a bit too. The stocks haven't really gone anywhere over the last 2-3 years now, Sameet. Would you buy them? There has been a time correction, if not a price correction.
So if you take specifically, Amaraja was facing a capex phase. Now it's about to get over in next 6 months, and some capacity has already come on stream. So that would help Amaraja to get back on the fundamental performances, because the pressure of the capex was on the P&L already and the revenue generation wasn't there. So that would help on Amaraja. On Exide is the opposite. So they are facing the upside capacity issue. So over there, the capacity utilizations are running at 85-90%. So that's a practical capacity peak which you can achieve. Going to 100 is almost next to impossible in battery factories. Now over there, now they'll enter capex phase, which they have already announced, and they're announcing the electric vehicle battery capex as well, and joint ventures as well. So I feel that both are facing the issues. Amaraja will be a better off play because the numbers of the capex are already suppressed in the P&L, and as soon as the revenue generation comes, there are upside leg to it, and instantly it will come in next 6 months. Lead coming off helps out to both of them, but that pass on happens on a quarter lag. So after 3 months kind of a downside, then only they can pass it off, because price cutting and revision of prices on the upside takes a very different toll on the volumes.
Interesting. Okay. Sameet, very quickly, 60 seconds. There's been a substantial correction in the mid-cap space. Some of it had bounced back too. Valuation-wise, is there something that looks really attractive? One name.
So JTKT. So earlier it was just called Sonakoyo. That we see a very big valuation. Yeah, it's corrected. If you want to say correction, there's a 10 to 15% kind of a correction. But what is happening, there's this restructuring happening by the new owners. So all the old directors, promoters are out of the firm now. The new promoters have come in, new directors have come in of the Japanese multinational parent company. They're merging a associate company with the listed company, which has better margins, better operational availability, and they are suppliers to that firm. So the listed firm supplies to the one who's getting merged. So they have a higher margin over there. So I think combined basis, the valuations are very cheap. They're trading around 20 times right now. But if you see on the valuation growth wise, there's a big leg up in next 2 to 3 years.
All right, we just have about 50 seconds left, so I'm going to quickly take the top picks for the day from our technical experts today. Sameet, coming to you, your top idea for today.
I'll go with Divi's. Certainly looks good. After a long consolidation, it has broken out. So I would recommend for a target of 1167, stop loss at 1096.
Rahul, how about you? What's your top idea for today?
Well, one stock I didn't talk about was HCL Tech. I think there's a tremendous opportunity there. So I'd look at 1055 as an intraday target. But again, going forward, we are expecting the stock to move closer to 1200.
Okay, tremendous opportunity. That's interesting. Thanks a lot for that, Sameet, Chavan, as well as Rahul, Mohindar. Really appreciate your time and joining in today. We'll just take in one initial thought from Sameet Kalra after the markets open. But here's what the markets are likely to do this morning. 0.5% higher. Yes, 0.5% higher for the Nifty Sensex and the Nifty Bank. No surprises here. Bang on in line with what the pre-open was indicating. The mid caps and the small caps too would probably reverse some of the cuts that they had yesterday. Yes, they have 0.5% for the mid caps. The small cap index 1/3%. So brisk start. Let's see if this lasts or not. In all probability, it could. The global markets too are looking fairly positive. A tick of green, a sea of green out here. Hardly any losers. I mean, the top loser is Mahindra and Mahindra, which is down less than 0.5% or about 0.5%. So really no big cuts there, but the gainers dominated by the oil and gas space. Dr. Reddy's, I think it was a call from Rahul Mohindar, if I'm not wrong, starting off 2.5% higher. Let's wait and watch. HCL Tech about 1.5% higher. Tech Mahindra. So technology, oil and gas, both of them are starting off well. Reliance, which has been a big supporter, is up about 1% too. And I somehow can't spot TCS amongst the top two rows, so it must be having a flat start. Lost somewhere out here. Oh, right here. TCS is very, very flat in the session today. So this one is not making any kind of substantial moves. But Sensex has hit all-time highs. This is an important level. It'll be a great conversation with Mahesh Nandurkar coming up as well. But very interesting moves that we're seeing on the benchmark indices. Let's talk about some specific pockets, 2 or 3 that I want to highlight before I hand it over to Agam. Crude price fall, and that should aid the OMCs for sure. All of them are up 5% apiece. That's a big start for the oil marketing companies. I would reckon aviation and some of the other sensitives too could be having a sentimental reaction. Yes, they are. Jet Airways, Interglobe Aviation, SpiceJet, all of them start off very, very well. Last but not the least, stocks which have been hitting new highs consistently. Let's see if the GCPLs, Tata Elxsis of the world are continuing. Not quite, but PNG has a couple of percentage points uptick. But today probably belongs to the high beta variety. And the markets now, the Nifty Bank 200 points higher. Agam, it's a brisk start and it's continuing from where it left off yesterday.
I'm going to start off with Ashoka Buildcon, as we were talking about it in pre-market as well, because that's the big gainer on NSE 500 at this point in time, up nearly 11% and 12.5% at this point. So we do have some gains coming in through, and GVK Power is the other one which is in focus. It's currently at up as much as 5%. Let's also bring in something like a Jet Airways. That's up as much as 4.4%. Can we expect more strength in the other aviation companies? Something like an Interglobe Aviation, that's up 3.5%. SpiceJet is likely to also trend higher. That's also higher by around 5%. Dilip Buildcon is the other one. That's also doing well. It has actually resumed its upward move now, well above the mark of 820 after seeing substantial volatility over the previous few weeks. And Chennai Petroleum is the other one, which is also buzzing on the back of gains at this point in time. On the losing end, we have General Insurance, and again, that's where there's some amount of weakness, not too much to speak for, considering the market breadth is well in favor of advances, but GICRE down 3%, and MES Financial Services, that's taking a knock around 1.5%. On the whole, when it comes to the broader markets, it's clearly the day where we're starting to see some, momentum building up when it comes to the gainers, and well, that's the way it's panning out, Neeraj, at this point in time.
A very brisk start. Final question to Sameet Kalra. Sameet, we already spoke about BPHP a bit earlier, but they've started off very, very briskly, as have the aviation companies. Flash in the pan move, or would you be comfortable buying them at current levels as well?
So you can start buying if you don't have into their short-term portfolio. There might be a intraday downside or a few points here and there, but I think on a long, as in a shorter 3-month kind of a horizon, I see the oil prices coming down further to around 65. So I think this will give a leg up to the OMCs of the world and the aviation pack. Because OMCs I prefer because the only point is the instant results in the fundamentals already come in, and others are passed on in quarter lag. So I think OMCs are the better place, which are already down substantially.
Okay, lots of ideas from Sameet today. Sameet, thanks so much for joining in today and giving us your perspective. Really appreciate your time. Well, it's 9:20, Sensex at all-time highs. What better time than to get Mahesh Nandurkar, India strategist at CLSA. He joins us right now on the show. Mahesh, thanks so much. Opportune time to have you. Very good morning. This is Neeraj here. We couldn't have had a better morning 3 days into the new week. Amidst all the talks of carnage in the mid-cap space, we're sitting pretty on the Sensex already. Nifty about 100 points odd away, or maybe just a few points away now. What's the thesis right now as we are approaching the Q1 earnings season?
Hi, good morning, Neeraj. So the Q1 result season is obviously around the corner. We are expecting that, helped by the low base, the YOY performance by the corporate sector should be good. We are expecting close to about 18 to 20% earnings growth. That would probably be the highest earnings growth that we would have seen in the last several quarters. So from the bottom-up perspective, from the corporate earnings growth perspective, things are beginning to improve. So that's a good news. The key source of worry, however, remains to my mind the macro and the top-down concerns. Remember that on various macro parameters like the inflation outlook, the RBI rate, the policy rate outlook, the fiscal deficit outlook, the currency, etc. And I would add even maybe a bit of political uncertainty as well. So the macro headwinds clearly stay, which is really the key source of concern for us if we look at the market performance from here on with, let's say, a 6-month or even a 12-month view.
All right, Mahesh, the last time we spoke to you, well, the general idea that we were getting from you was that at this point in time, the bond markets were looking more attractive in comparison to the equity markets. That said, when I'm looking at the institutional flows in India, the outflows from the bond market is much more pronounced when it comes to the equity markets. Can you tell us a little more about how you're reading these clues based on your views on both these markets?
Okay, so just to clarify, when I said that the debt markets are looking more attractive, and I still hold that view, I'm talking more about the short duration debt market. So I'm not taking a call on the bond yields. I think that taking a call on the long bond, a 10-year or a 15-year GSEC is still a bit risky in my view, because I do see the yield remaining at the elevated level, and there is an upside risk from here on as well. I won't rule out the yields going up further up to say 8.25, etc. So just to be clear, what I meant that time and also what I mean this time as well is that from the next 12-month perspective, I think the class of financial assets that should give maximum risk reward return is the short duration bond. So 1 year, 2 year, 3 year kind of thing.
Right, Mahesh, in that case, let me take your view on what you think about the interest rate trajectory in India. Well, a lot of analysts out there are factoring in at least another rate hike from the RBI. What is your view on this one and the potential impact it can have on equity markets going in?
Yes, so at least one rate hike I think is given. My sense is that there will be more than one rate hikes over the next 6 to 12 months, could be even 2 or 3 in my view. And one of the drivers for that decision would not just be what is happening on the inflation front. That is obviously is the key guiding principle which the RBI follows, but we'll also have to take into consideration what is happening on the rupee side as well. Remember that over the last 3 months, RBI has used up about $25 billion of reserves in stabilizing the currency, and that $25 billion is inclusive of the forward cover. It's not just the spot that I'm talking about. So we have used substantial amount of our forex reserves in stabilizing the currency, and yet year to date INR is the worst performing currency in the Asia region. So there are risks on that side as well. And we have seen, except for China, the other regional central bankers raising rates to defend the currency. Obviously, that's not really the mandate for the RBI, but they will also keep that in mind. So I would say definitely more than one rate hike over the next 6 to 12 months.
Mahesh, in which case, what is the biggest risk to your mind? You outlined 3 or 4 macro factors which could be headwinds. Politics is probably anybody's guess. We couldn't quite know that. But aside of politics, what's the biggest red flag for you right now? Because we are sitting at fresh highs and you are talking about red flags to the markets currently.
All right. So from the macro front, we have been highlighting the fiscal concerns, the fiscal deficit falling short, and which will probably have some implications on the bond yields, inflation as well. But the single biggest macro factor which is holding up quite nicely as we speak is the inflows into the domestic equity mutual funds. So we have seen some slowdown on that. The second half of last calendar year, we were seeing inflows of around 18 to 20,000 crore per month. That number has now come down to about 10,000 crore, but that still is a very respectable number. And despite this slowdown, a little bit of a slowdown that we've seen in the mutual fund inflows, the markets have still gone up in the last 3 months. And the primary reason for that is the fact that we did not really have any meaningful or a big equity paper supply in the market. So from the equity demand supply perspective, things have still been on the positive side. So my worry sitting at the current point in time is that this demand supply equation might change for worse in the next 3 to 6 months. And the reason for that is twofold. One is that most of the corporates who want to raise money in the current financial year will probably like to get done with that, say by October or November, because from December onwards, the political uncertainties, will begin to play a role. And I don't think, many companies will plan their equity raising at that point in time. So most of the companies will probably, try to, finish the equity offerings in the next 3 to 6 months. And if we continue to see the current level of inflows on the domestic side and the trend continues on the foreign inflow side as well, my worry is that the equity demand supply will turn for worse, and which will be the single biggest risk for the market in my view.
Interesting. Mahesh, what do conversations with your global clients suggest? Yes, we've seen outflows and that's not been India specific, but is anybody talking about putting fresh money, big money to work into India or EMs by and large, or is it a sit on the sidelines kind of a mode currently?
See, what has been happening in this current calendar year so far is that the emerging market funds have been seeing some outflows. The US markets has been big outperformer, and to that extent we have seen the flows to the emerging markets, including India, being on the negative side. Obviously the dollar has been quite strong currency as well. I don't think there is any big money waiting in the sideline to come into India at this point in time. But yes, what has happened is that over the last couple of months, on a relative basis, Indian markets have outperformed. And the reason for that is there have been some bigger, I would say, risk or concerns coming up in the other emerging markets like Turkey, Latin American markets, Russia, etc. So as compared to the emerging markets, in general, Indian markets have held up much better over the last 2 to 3 months. So as of now, some of the investors are looking at India as probably a place to hide, also in the large cap space, because there you have several companies like the IT services and the commodity exporters, etc., which are not really linked with the domestic economy and where the trend has actually been quite strong. So the global investors have been looking at India as a place to hide. to some extent, and within that, it's the large cap and exporters which have been the point of attraction.
Right, Mahesh, you did mention that there's been some strength when it comes to markets and equity markets in the US, and we are seeing substantial moves in the European markets as well. One, what is your assessment of the equity markets abroad, and two, can we expect some amount of, should I say, weakness going in? If that is the case, what impact can it have on India? And how insulated are we from the equity markets at this point in time?
See, if you look at the global developments and the impact of that on the emerging markets and also on the Indian markets, clearly there will be some positive news, there will be some negative news, the market will be volatile, that's there. But we should not lose the sight of what are the bigger trends happening in the global markets. And the bigger trends is that, one, the US Fed has already started raising rates. They have hiked the rates a few times in the last 12 months. Over the next 6 to 12 months, there will probably be another 2 to 4 rate hikes, adding up to 50 to 100 basis points. Also, if you look at what is happening in Europe, the ECB has already talked about their tapering program of the QE. So the interest rate scenario globally has been towards a trend of going up. Also, the global liquidity conditions are also slowly tightening. So that is really the big macro trend globally that we need to keep in mind, which will keep the equity valuations under pressure globally and certainly in the emerging markets, including India.
Right, Mahesh, recently we had the MSPs announced by the government. What are the other policies that are likely to influence markets and economy in general, especially keeping in mind that we are less than a year away from the general elections?
And actually, if I can just add a follow-up out there, Mahesh, on the MSP itself, you guys have been writing about this now for the last 6 to 9 odd months, if I'm not wrong. How big an impact for the rural sensitive stocks would this be, if at all?
Yes, so as you rightly mentioned, keeping the elections in mind, there has to be some focus on the rural economy revival, and which is the right step that the government has been taking. We know that the rural wage growth has slumped to an all-time low of close to around 3 to 4%, and that definitely needs to go up from the political perspective. So MSP hike has been one. We've obviously seen a few announcements at the state government level on the farm loan waiver. And going forward, I think there will be many other programs that will be taken up, such as, so even when we talk about the roads program, mind you that nearly 50% of the capex for a road project goes into land acquisition. And that essentially is money going into the hands of the farmers or the landlords, basically most of which goes back into the rural economy. So my sense is that it will be a combination of several of these MSPs, farm loan waivers, road program, and the other initiatives, such as obviously the government has been talking about the medical insurance program. Let's see how that rolls out. There are certain states which have talked about certain innovative schemes like certain 4,000, 5,000 rupees per acre per crop as the subsidy and so on. So expect this kind of policy framework to remain both from the central and from the state government side over the next 12 months or so. And naturally, this should have a positive impact on the rural facing industries and the companies. So the staples companies, the two-wheelers to some extent, also on the four-wheeler side, including the tractor companies and so on, should clearly be the beneficiaries. There will be some consumer durables as well, like the electricals or the fan fitting companies, etc. So some of those low-ticket items of consumption should definitely see some fundamental improvement in the growth outlook.
FMCG, Mahesh, see a leg up? I mean, the stocks are trading at valuations which are abnormally high, higher than their averages, higher than probably valuations that they have traded in the best of times in the last 8 or 9 odd years. But this should give a leg up to earnings for sure. What do you do out there? It's a bit of a tricky call.
Oh, absolutely. So you've hit the nail right on the head, especially on the staple side. The multiples are at an all-time high. So there, one can take a relative value approach. So we definitely see relative value in tobacco stocks, for example, which are trading at almost 40 to 50% discount to the leading FMCG companies. So that is certainly a space to watch out for. And similarly, we can see some value based buying that can happen on the tractor side, and there are a few other stocks on the two-wheeler side as well, where we can see the relative value.
All right, so in that case, Mahesh, I want to move on and address the technology sector as well. Well, in this case, we've started to see the largest company in the IT sector, the Indian IT company come through with good earnings. Does this set the tone? And I'm not talking about TCS specifically in this case. I want you to give us a better picture of what we can take from the earnings when it comes to the entire sector as a whole. Has it turned a corner, and can we expect better things to come from the entire sector?
Yeah, so the thing is, rupee weakness is definitely a tailwind for sectors like IT and pharma. And also the result season has off to a very good start, and the commentary from the from the top two companies, in fact two of the largest companies that have already reported, clearly shows that there seems to be some signs of revival in the US BFSI space, which is actually one of the largest business verticals for most of the IT companies in India. So once again, one can look for relative value within the IT space as well. There are certain large cap stocks as well, which are trading at a significant discount, and some kind of a value buying should be done there as well. On an overall basis, we continue to maintain a neutral stance on the IT side, but the exporting sector that we are very, very bullish on is pharma and healthcare. We are actually recommending a double overweight on pharma at this point in time. And the reason, apart from obviously the rupee related tailwind, is that the worst in terms of the news flow seems to be behind. We are slowly beginning to see the pricing pressure which has hurt the performance of the pharma stocks stabilizing, and that's also in the base. So from the year-on-year comparison perspective, FY19 should be a good year for the pharma sector in terms of earnings growth. We are expecting more than 20% earnings growth, and it's also a sector which is not that well owned in the institutional space. And keeping in mind that the news flow seems to have turned the corner, we remain optimistic, much more optimistic on pharma than IT at this point in time.
Right, Mahesh, I just want to stick with IT for one more question. There is a substantial difference between the large cap, the leaders in the information technology sector, and when it comes to the relatively smaller ones, they're all doing their own thing, creating their own niches. So when it comes to the relatively smaller ones, how would you go about picking the right stock? What are the properties and perhaps some other factors that you'd keep an eye on, look out for when it comes to picking stocks in, well, the broader IT sector?
See, in the broader IT sector, I would say that one doesn't really need to go down into the mid-cap space just for the sake of valuation, because even within the large cap space, there are large valuation differences. And so even if you look at the large four IT companies in India, there are a couple of them which seem to be trading at a relative value. So if you're looking at valuation perspective, you can find enough value in the large cap space as well. On the mid-cap side, obviously, every company has, its own niche, and I can't really get into the company-specific details here. But I would just reiterate that, the large-cap space also offers decent opportunities at this point in time.
Mahesh, we started off this discussion with a quick snapshot of the earnings. The question that I have is, at the end of Q4, I distinctly remember almost everybody saying that the earnings recovery in FY19 will be back-ended. Most of the sell-side heads of research or strategists are now penciling in an 18 to 20% growth in quarter one itself. Does this set the tone, one, for the earnings season at large for FY19, and two, does it improve the sentiment in the broader market if we indeed clock in about a 20% growth? Because then we're not talking about a back-ended earnings recovery. We're talking about the earnings recovery happening in quarter one itself.
Look, the quarter one has the benefit of a very low base. Remember that we entered into the GST framework on the 1st of July, and therefore the first quarter of FY18 was severely impacted for several consumer and some of the mid-cap companies and so on. So clearly we are also seeing the benefit of the low base helping the YOY comparison in the first quarter of FY19 because of that GST impact. So I would still say that the second quarter may not be as good as the first quarter, but yes, eventually things will begin to improve as we go towards the second half of FY19. And one of the big segments that in the domestic economy where we expect to see a significant improvement is the real estate space, the property space, where we see that the things have already bottomed out in my view, and there are some small pockets where we are seeing an encouraging sign of the demand recovery. Also, from the listed real estate space, they not only benefit from any potential improvement in the property markets in general, but also the fact that RERA has driven industry consolidation, and we are seeing market share gains for the larger players. Also, their cost of funding is much lower, etc. So the listed players in the real estate should also see the benefit of that. But that's obviously a much broader trend in the economy in general, which should help improve the the bottom up, the economic growth perspective from the second half FY19 onwards.
Interesting. Mahesh, Nandurkar, we could actually carry on, but I know time doesn't permit it. But thank you so much for taking the time out and speaking with us today. Really appreciate it.
Thank you very much.
That's an important market voice on an important day when the markets, the Sensex has nudged record highs as well. And they're doing well for now, so we're not really cooling off from where we started off 20 minutes into trade or 25 minutes into trade, over 0.5% for the benchmark indices, Nifty Bank almost 1%. So it's a good start, but it's thanks for watching this leg from Agam and me. We take a quick break, come back and talk about a mid-cap or a small-cap name that has actually done reasonably well over the last 1 month, maybe the last 1 year. Bharat Rasayan up about 20% in a month gone by. Is a good monsoon changing the fortunes, or is there more to it? We asked the President Abhishek Aggarwal about this on the other side. Stay tuned.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution hai. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Emerge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई, हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Emerge. साथ हमारा, सफलता आपकी. The SME Growth platform from India's largest stock exchange.
Catching up on news feels like a test match. Want the highlights? We hear you.
It's
It's an ocean of news out there. Need a navigator? We hear you. Do you have analysis paralysis? A case of too much information and not enough time? Do you wish someone would just pick the most relevant topics and tell you what you need to know? We hear you.
Good morning. You're watching Bloomberg Quint. This is First Word.
Curated and presented by Bloomberg Quint's senior most editors. Weekdays at 8 a.m.
Back with us on Indian Open right here on Bloomberg Quint. It's been a promising start to the monsoon season, and that means good news for farmers across the country. Another stakeholder who's got a lot riding on the sowing season are the insecticides and the pesticide companies. One such player is Bharat Rasayan. What saw its stock hit a new high just a few days back, in fact yesterday or day before. Joining us right now to talk about this harvest season and beyond and what could happen to the company over the course of the next 12 to 24 months is Abhishek Aggarwal. He's President for Strategic Alliances and Corporate Sales at the company. Abhishek, good having you. Thanks so much for joining in. First, tell us a bit more about what do you guys at Bharat Rasayan do and how has business been for you over the course of the last 2 or 3 years?
So basically for any Indian agrochemical company, there are 4 verticals of the business. The first vertical is the brand business where we sell the product to the farmer who is the end customer for us, and that we do through a network of distributor and the dealers. The second business network is the export business where we export our molecules all over the world. The third vertical of the business is the B2B business where we supply the product to other corporate clients. And the fourth vertical of the business is the contract manufacturing where we do contract manufacturing for various MNCs and the Japanese clients. So Bharat is a unique company which is present in all the 4 verticals of the business.
Interesting. What's the strongest performing vertical for you? I'll add part 2 of my question. What's been the strongest geography for you? As I see in the geographical breakup, Asia and Middle East probably constitute about 77% of your overall sales.
So yeah, basically Bharat is extremely famous for its manufacturing capabilities. And we are majorly focused on manufacturing of products in indigenous manufacturing. So Bharat is banking on the indigenous manufacturing. So if we talk about the world market, we know that there has been a lot of consolidation which is going on as of now. And the world market is basically being handled by 4 major players. We have Chem China, Syngenta, Adama being one player. We have Dow DuPont being the second player. We have Bayer Monsanto being the 4th player. And we have BSF being the 4th player. So all these 4 players contribute to more than 78% of the world market. However, the story in India is a little different where the Indian companies have a larger share as far as the world market share is concerned of other companies. Now for Bharat, the main business is contract manufacturing and the B2B business and the brand business. And we, based on the manufacturing capabilities, are able to export our products worldwide. So I can say that all the verticals of business are complementing each other, and hence Bharat is a stable organization.
Okay. As I see your financials, Abhishek, the last few years, I'm not really breaking it down into specific quarters, though I do see that on a quarterly basis too, you've done reasonably well. But as I look at the years, FY14 to FY18, your numbers, your top line has more than doubled from 361 crores, if I'm not wrong, in FY14 to close to about 800 odd crores in FY18. The bottom line performances are robust. Your margin profile has improved marginally at that, but has improved too. What's the roadmap for the next 3 or 4 or 5 years?
So basically, as far as the numbers are concerned, it's not something which has happened overnight. This is basically something which started with the Beijing Olympics, where the bubble of the pollution issue started in China. And the Chinese government became much more stringent on the pollution norms. And a lot of work has been done by the Chinese government to basically curb the companies who are not following the environment and the pollution norms there. And that is where the opportunity came for companies like Bharat, who were having a strong manufacturing base. And there has been a stringent inspection by the Chinese government, which has led to closure of many of the agrochemical companies in China, and hence the opportunity has come to players like Bharat. Now going forward, I would not like to talk much on the strategies, but our strategy majorly revolves around manufacturing base and attaining self-sustainability and backward integration.
I mean, I'm sure a lot of other companies do that too, Abhishek. It's not that the other peers that you have, for example, don't have a really strong manufacturing base either. Could you actually tell me who are your strongest competitors in the one or two of your largest products that you are in, and what's the market share that Bharat Rasayan as a company has within those pockets?
So basically, if we let me take you to the beginning. The company was started by our chairman, Mr. S.N. Gupta, and later on he was supported by Mr. M.P. Gupta and Mr. R.P. Gupta. Now, Bharat being a manufacturer of the technicals where we can even compete the Chinese manufacturing cost. As far as our competitors or the peer companies are concerned, the ecosystem in India is very small. If you talk about China, there are thousands of companies who are into manufacturing of basic agrochemicals or basic raw materials and intermediates. But as far as the India is concerned, the ecosystem is very small. So the opportunity for companies like Bharat and other companies are here to stay. So we do not really feel any competitors are there, but we can say that the ecosystem is small, and hence there is an opportunity for all the players.
But what's your market share in the two of your strongest products, Abhishek?
So as far as our strongest products are concerned, there are around 4 to 5 products where our market share is more than 50%.
Okay, and do you envisage that market share
manufacturing?
Okay, do you envisage the market share moving up? And two, does this whole unorganized to organized play work in for a company like you as well? And thereby, do you see the organized market growing and your share within that growing as well?
So I will talk as a holistic point of view. If we actually see the molecules which we are working on are agrochemicals. Now, in case of agrochemicals, basically agrochemicals are made by the multinational companies and the Japanese players who are the innovator of the molecule. And now these innovators are majorly dependent on China for the manufacturing of this product. And normally the ratio is 80:20%. So 80% of the manufacturing was done in China, and 20% of the manufacturing was done in the native country, be it Germany, US or Japan. Now, of late what has happened, because of the pollution norm or the environmental norm issues in China, the manufacturing base or the 80% share which was with the Chinese company is seeing a shift. So now the new ratio I personally feel is 20 native, 20 to 15% to India, and 60 to 65% still remains in China. Now with this 20 to 15% which is coming to India, there are very few companies in India who have the capability and the capacity to comply to the environmental and the pollution norms of these multinationals. So the multinationals or the Japanese players are looking towards India for manufacturing of these agrochemicals, and herein, since the ecosystem in India is small, the opportunity for companies like Bharat and other companies will be prevalent in future also.
Interesting. I believe you have two manufacturing units, Bahadurgarh and Rohtak, if I'm not wrong. That is Dahej, Kathua, and one in Himachal Pradesh. If indeed the options or if indeed the opportunity is so large, are you looking at any strategic capex in order to enhance your manufacturing capabilities?
So as a management protocol, we do not speak much on the strategies. I can only say the management strategies are very clear for the future, and we have good plans which is revolving around the manufacturing capability enhancement, and let's hope that everything falls in place.
And I'm sure of that, but my simple question is, I mean, are you operating at optimum capacity utilization, and therefore do you need to expand capacities, or do your current capacities serve you well for the next few years?
So we are already working on a greenfield project for the future.
Okay, that explains it. And I'm presuming
so
you are sufficiently
as of
funded.
now, which we have in both the plants are.
I presume you'll be sufficiently funded for any kind of capex that you would need to take, the Greenfield project or any other that come your way?
So we have the arrangements.
You have the arrangements. Okay. One final question, Abhishek, and that is on what do you expect the year to look like? I wouldn't want to, I know you want to get into specific numbers, but the kind of growth rates that you've maintained over the last 2 or 3 years, can we expect similar growth rates in FY19 at least?
So I can talk about industry as a whole. I personally feel that one of the major factor for all the agrochemical companies in India will be the self-sustainability. Now there is an opportunity which has come due to the factors in China. The companies who are capable enough to retain this and be self-sustainable and reduce their dependence on China will be the companies which will be doing good in future. So the key area here is the self-sustainability.
What about the growth rate though? I mean, with that self-sustainability, do you believe the growth rate that you've clocked in the past can be replicated in the future, FY19 at least?
So any industry player who will be able to attain the self-sustainability and will be working on innovations and the R&D in future will be able to continue with the growth rate which he is doing as of now. However, every opportunity has a catch-20 situation. We have to understand how the China situation changes and other factors are also there. But the companies who are having a strong manufacturing base and are investing on the future manufacturing base will be here to stay.
Okay, Abhishek, we'll leave it at that. Thanks so much for taking the time out and speaking with us. Probably talk to you guys once your numbers are out. But thanks for joining in today.
Thank you very much.
That's Bharat Rasayan. Good numbers, good return ratios, management confident of growth rates sustaining with some caveats, of course. The markets, though, doing very well for themselves, 1% higher. The Nifty Bank is trading at the highest point of the day. But it's not that it's just the Nifty Bank. The broader end of the spectrum, too, seems to be doing rather well. Trent, 6.5% higher. Jet Airways, another 5%. GVK Power, the last 3 days has been on an upper circuit, up another 5% in the session today. Bajaj Electricals has some gains to itself today, up about 4.5% at 564. That is packing a serious punch. Ashoka Buildcon, about 6.5% higher. And DCB Bank, too, nudges up in the session today, up about 4 or 5%, 4% actually at 185. So the broader end of the spectrum too seems to be doing rather well. Not enough losers or not many losers. That's essentially the key, both on the large caps and the mid caps. I just want to mark one stock though. Infosys, after having a fairly decent run yesterday, is seeing some bit of selling pressure today. 1% off for Infi in trade. But with that, it's a wrap on this leg of Indian Open. All of this stock spotting and some specific movers and shakers being taken up on the FNR show that comes up next. Stay tuned to Bloomberg Quint Live. Thanks so much for watching Indian Open.